Hey everyone, I'm excited to be sharing this video with you today on the legendary investor Warren Buffett's proven strategy for generating enough passive dividend income to retire early and live life on your own terms. After 50 plus years of outperforming the markets, Warren Buffett has provided immense wisdom on all things investing. But specifically, Buffett has provided great insights into the power of dividend investing as an income generation tool. In today's in-depth video, we're going to cover the core principles behind Warren Buffett's love of dividend investing, key metrics Buffett looks for when evaluating dividend stocks, an overview of Buffett's 4% retirement rule, a step-by-step guide on how to build a dividend portfolio fast enough to retire early. By the end, you're going to have a complete blueprint to implement Buffett's strategy to produce enough consistent passive income with dividends to retire early and live life on your own terms. So let's get started. Buffett's core philosophy on dividend investing. At his core, Warren Buffett is known for long-term fundamental investing strategies focused on quality companies selling at reasonable valuations. However, dividend investing plays a pivotal role in his overall philosophy, which is often overlooked. In his 2011 shareholder letter, Warren Buffett spelled out his love affair with dividends when he stated, "I love receiving dividends from the stocks Berkshire owns, and it's easy to understand why." Buffett loves dividends because they offer shareholders a reliable, recurring cash flow stream that continues to pay out even when market conditions sour and stock prices decline. The cash keeps flowing regardless, providing stability and inflation resistance. Secondly, receiving dividends today allows for greater compounding returns down the road if they're reinvested year after year. The more compounding years you have working in your favor, the larger your income stream and total returns grow. Thirdly, Buffett views significant dividends as an indicator of strong underlying business performance and responsible management focused on delivering shareholder value. Quality dividend payers tend to dominate their industries and have financial discipline baked into their DNA. Evaluating dividend stocks like Warren Buffett. So, Buffett loves dividends, but he doesn't invest in just any high-yielding stock. He focuses on quality dividend payers supported by strong underlying fundamentals. When evaluating dividend stocks, Buffett suggests focusing on three core metrics. Payout ratio. This measures what percentage of a company's total net income is paid out to shareholders in the form of dividends. It's an important metric measuring the safety and sustainability of the dividend payment. Buffett wants payout ratios below 60%, which indicates there's ample room to continue paying and growing the dividend. Companies too stretched with high payout ratios above 80% raise red flags. History of dividend increases. The longevity and consistency of a company's history of raising dividends reveals a lot about its priorities and reliability. Buffett loves stocks with at least 10 plus years or longer track record of consistently increasing dividend payments year after year. The longer the streak continues to raise dividends, the more confidence it provides. Underlying business fundamentals. Ultimately, you want to invest in quality companies with strong business fundamentals rather than chasing high yields alone. The safety and longevity of the business itself matter because it must support continued dividend payments. Buffett examines metrics like the return on equity, profit margins, growth prospects, debt levels, and competitive advantages when assessing a dividend payer's business strength. The safety of the underlying business and dividend matters greatly. Buffett's 4% retirement rule. Once you've done your due diligence on the quality dividend payers to invest in, an important question arises. How much money do I need to retire? Or, said differently, how much dividend income do I need to live off for the long run? This is where Warren Buffett's famous 4% retirement rule comes into play. According to Buffett, if you build a diversified portfolio of quality dividend stocks averaging a safe 4% dividend yield in total, you can safely withdraw 4% of your total portfolio value every year to live off those dividends without touching the principal. For example, say you've accumulated a diversified portfolio worth $1 million, averaging a 4% dividend yield across all the stocks. This portfolio would generate $40,000 in annual dividend income that you could live off each year without having to sell any shares of the stocks themselves, a perpetual income stream to retire on. This 4% rule works because the remaining portfolio continues growing independent of withdrawals. So your income stream and total portfolio value keep pace with inflation over the long run. Of course, this requires you to build a portfolio large enough to generate your needed level of passive income. So, what's the safest way to build a dividend stock portfolio substantial enough to retire early on dividends alone? Let's get into the step-by-step game plan. How to build a dividend portfolio fast enough to retire early. Step 1. Start investing early and stay consistent. One of the biggest factors enabling dividend investors to retire early boils down to time. The earlier you start investing, the longer your money has to grow and compound. Even small amounts invested consistently in your early years can snowball into huge sums later down the road, thanks to compound growth and reinvesting dividends over decades. So, investing early and staying consistent for long periods of time offers a monumental advantage. Use the power of time to your advantage by starting to invest in dividend stocks as soon as realistically possible, whether while still in school or at your first job. Get time working on your side. Then commit to investing portions from every paycheck consistently for decades on end. Step 2. Reinvest your dividends and portions of each paycheck. You absolutely want to reinvest your dividends through automatic dividend reinvestment plans or DRIPs rather than take the cash payout. DRIP programs allow you to use dividends to automatically buy more shares of the underlying stock fractional shares at a time. Through dripping, you put your dividends back to work, expanding your ownership stake. This turbocharges your compounding by growing your share count and dividend income faster over time. The more shares you own, the more dividends you receive. The more dividends you receive, the more shares you can add. It snowballs over the years. In addition to reinvesting dividends, you also want to continually add new money from each paycheck on a fixed schedule into buying more dividend payers. This expands your snowball effect even further. Step 3. Use retirement accounts like Roth IRAs to turbocharge growth. In addition to standard taxable accounts, using retirement accounts like Roth IRAs can dramatically accelerate dividend portfolio growth. With Roth IRAs, your withdrawals and dividend income are 100% tax-free in retirement. Since you don't pay taxes on dividends along the way, you end up reinvesting more capital with each dividend payment compared to a standard taxable account. Plus, your total nest egg can grow substantially larger thanks to decades of tax-free compounding. Opening a Roth IRA account early to complement your taxable portfolio is a great way to kick growth into overdrive. Max it out each year you qualify, and make sure to consistently add new capital from each paycheck on top of reinvesting dividends. Step 4. Construct a diversified portfolio mix focused on dividend stocks. In constructing your portfolio, you want to build a diversified mix focused predominantly on safe, high-quality dividend growth stocks. Balance is important because market conditions fluctuate, so cast a wide net with dividend payers across many industries and economic sectors. Specifically, allocate significant portions toward legendary dividend aristocrats and dividend kings. These are elite S&P 500 companies boasting track records of consistently raising dividends annually for 25-plus and 50-plus straight years. They provide very reliable, recession-resistant income streams perfect for retirement. Beyond that core base, sprinkle in some higher-yielding real estate investment trusts or REITs, master limited partnerships or MLPs, business development companies or BDCs, exchange-traded funds or ETFs, and closed-end funds or CEFs for diversification and boosting overall portfolio income. Manage risk by limiting position sizes, but stay predominantly focused on reliable blue-chip dividend payers. Step 5. Be patient and persistent for years or decades. Once your dividend snowball is set in motion, reinvesting dividends, adding new funds consistently, harnessing compound growth, it really starts to pick up momentum and scale. But it takes years for the growth to really kick into high gear. The key is patience and persistence. This isn't a get-rich-quick scheme, but the long-term rewards can be life-changing if you stick with the process responsibly. Be prepared to build your portfolio over decades before hitting critical mass. It takes time for the compounding growth machine to reach escape velocity momentum. However, allowing 20 to 30 years for your portfolio to mature can generate the dividend income stream you need to retire fully on. Stay persistent and don't get discouraged by short-term market swings. The long-term trajectory will have you reaching your goal as long as you remain committed over decades. In summary, the keys to retiring early with dividends. All right, we've now gone in-depth walking through the step-by-step blueprint behind Warren Buffett's ultra-fast dividend strategy to retire early. Let's recap the key takeaways. Start investing early to utilize time and compounding decades down the road. Reinvest dividends and portions of each paycheck to compound growth. Use Roth IRAs to allow tax-free compounding growth. Build a diversified portfolio mix focused on safe, rising dividend stocks. Stay persistent for potentially decades until your income stream hits critical mass. Follow the 4% rule for determining the size nest egg needed to fund your lifestyle. If you follow these steps religiously over your working lifetime, your dividend income stream will reach a point where it funds your entire lifestyle without needing a job, and you can comfortably retire very early to live your life entirely on your terms. I hope this video has outlined a clear game plan to retire decades earlier than traditional retirement age by executing on Warren Buffett's proven dividend strategy. Please like, comment, and subscribe if you found this helpful. I'll catch you in the next one.